500 storage units can bring in almost $1 million dollars a year. And after the normal costs of running the property, around $666,000 could still be left. At least that's what the numbers seem to say. Because when I first looked at this business, it almost looked unfair. Customers move their own stuff, they lock their own units, they pay you every month, and the building just sits there. So I started wondering, is owning a self storage facility actually one of those businesses where most of the money really does stay with the owner? Because if 500 units can collect around $952,000 every year, and the operating margins really can reach around 70% or more, then this could be an incredibly profitable business. But there was a problem. I was looking at how much the facility could make without asking how much it would cost me to own it. And those turned out to be two very different questions. So before I could figure out whether this business was actually worth owning, I needed to know whether that first number was even realistic. Can 500 storage units really generate almost $1 million dollars a year? Our model has around 500 units. Using industry portfolio data, that works out to roughly 63,300 rentable square feet. Now, the units aren't all the same size. Some might be small, some much larger. So instead of trying to price every single room, I used the rentable square footage. The base rental figure in the research was about $16.34 per square foot per year. But that number alone doesn't tell me very much because a storage facility isn't making money from every square foot unless somebody is actually renting it. So I needed occupancy too. For the base case, I used 92%. Now the calculation becomes pretty simple. 63,300 square feet times $16.34 times 92% occupancy comes to approximately $952,000 a year. So that first number actually held up. Under those assumptions, 500 storage units really could produce something close to $1 million dollars in annual rental revenue. And honestly, that was already more than I expected. But revenue wasn't what I really wanted to know because a business can collect a lot of money and still be a terrible business. What matters is what survives after the costs. So I started taking those out: payroll, property taxes, insurance, marketing, utilities, repairs, maintenance, and the other expenses required to keep the facility operating. Using a modeled operating cost ratio of around 30%, approximately $286,000 disappears, which leaves $666,000 of net operating income. So now the model looked like this: $952,000 comes in. About $286,000 goes out to operate the property, and roughly $666,000 remains. That's around a 70% property level operating margin. And suddenly the business looked even better than it did at the beginning because this wasn't just a facility collecting almost $1 million. It was a facility that could potentially keep around two-thirds of $1 million after the normal costs of operating the property. At that point, I thought I had basically found the answer. Maybe self-storage really was one of those unusually profitable businesses. But then I noticed something. I had spent all this time calculating what the property could earn without ever calculating what the property itself was worth. And that matters a lot because keeping $666,000 a year sounds incredible. If the thing producing it only costs a couple of $1 million, but what if it costs 5 million or 7 million or 10 million? The profit number hasn't changed, but the investment completely has. And once I finally put a price on the facility, the 70% margin stopped looking nearly as impressive because I knew what 500 storage units could make. I still had no idea what it would cost me to own them. I had been staring at the income. $666,000 of NOI. But now I needed to put a price on the building generating it. Recent self-storage transactions in the research worked out to around $145 per rentable square foot. So I went back to our modeled facility, about 63,300 rentable square feet. Multiply that by $145, and suddenly the building isn't a simple collection of empty rooms anymore. It is worth approximately $9.18 million. That changed the way I saw the 70% margin. Because, yes, the property could keep around $666,000 after its operating expenses. But someone might have to spend more than $9 million to own the asset producing that income. So I divided the NOI by the modeled purchase price. $666,000 divided by $9.18 million gives an unlevered yield of roughly 7.3%. And this was where I realized I had been mixing up two completely different numbers. The operating margin tells me how efficiently the property turns revenue into operating income. But that doesn't tell me whether buying the investment is attractive. The property could be extremely efficient, while the return on the money required to buy it is much smaller. And there was another problem. Most people buying a $9 million property aren't handing over $9 million in cash. They're financing it. So I modeled approximately 70% debt on a $9.18 million facility. That means a loan of roughly $6.43 million. And the buyer still has to provide about $2.75 million of equity. Depending on financing between roughly 65 and 75%, the initial equity requirement in our model lands somewhere around $2.3 million to $3.2 million. And that's before things like closing costs and reserves. So this definitely wasn't the kind of business where somebody buys a few locks, rents a small building, and starts collecting checks. The first check alone could be measured in millions, but borrowing that money creates another expense. Using the modeled financing terms, about 6.7% interest, with a 25-year amortization, the yearly debt service comes to roughly $530,000. And now I could finally follow the entire dollar. Start again with $952,000 of revenue. Take away $286,000 in property operating expenses. That leaves $666,000 NOI. Then take away $530,000 of annual debt service. And what remains is approximately $136,000 a year in pre-tax owner cash flow. Almost $1 million entered the facility. But under this financing model, around $136,000 reached the owner's cash flow, compared with roughly $2.75 million of equity invested. That's around 4.9% cash on cash. And suddenly the business I thought was keeping 70 cents from every dollar looked completely different. But $136,000 was still positive. So the next question wasn't whether the facility could make money. It was much more important. How easily could that $136,000 disappear? To answer that, I kept the basic facility the same and changed the economics around it. Same approximate 500 units. Same type of business, but different rent and occupancy. First, the weak case. Instead of $16.34 per square foot, rent falls to $14. And instead of 92% occupancy, the facility falls to 80%. Under those assumptions, revenue drops to approximately $709,000. Now, some expenses fall with activity, But many property costs don't disappear just because units are empty. So, in this scenario, modeled operating expenses are around $248,000, $709,000 revenue minus $248,000 leaves about $461,000 NOI. And now the debt bill arrives. About $530,000. So the final result is not a smaller profit. It is a loss. Negative $69,000 a year. That surprised me because this facility is still collecting more than $700,000 from customers. It looks busy. It generates substantial revenue, and the modeled owner is still losing cash. Now, compare that with our base case. $16.34 rent, 92% occupancy, $952,000 revenue, $286,000 operating costs, $666,000 NOI, $530,000 debt, result, positive $136,000. Then I push the numbers in the other direction. Strong facility, rent, $20 per square foot, occupancy, 94%. Now, revenue climbs to approximately $1.19 million. Operating expenses in the model are around $343,000. That leaves roughly $847,000 of NOI. Take away the same approximate $530,000 of debt service, and the owner is left with around $317,000 a year. Weak, negative $69,000. Base, positive $136,000. Strong, positive $317,000. That's a spread of roughly $386,000 every year. And here's the strange part. The basic product didn't really change. There's still storage units, still square footage, still doors. What changed was the financial environment around them. Rent, occupancy, expenses, and what the owner paid to control the property. Then I looked at break even. Under our base rental and financing assumptions, the facility needs occupancy of roughly 77%. Below that area, the economics become increasingly uncomfortable. And that showed me why self-storage isn't simply a game of filling every room. You need enough occupied units at high enough rents to support a very expensive piece of real estate. But there was another assumption I had been making without noticing it. Every one of these calculations depended on customers continuing to rent the units. I had treated those renters as if they simply appeared. They don't. And once I started looking at what it takes to keep replacing them, the idea of completely passive income started getting weaker too. Self-storage can look passive because the physical product doesn't move. The room stays exactly where it is. But renters do move. People leave. New people have to replace them. And large storage operators spend real money making that happen. Using the advertising economics from the approved research as a benchmark, our modeled facility would support an advertising budget of around $18,500 a year. Based on the modeled turnover, that works out to roughly $60 to $65 of advertising cost per replacement move-in. That isn't an enormous number by itself, but it changed the picture. Because the building might sit still, while the business behind the building keeps moving. Someone has to attract renters, manage pricing, handle move-outs, replace vacancies, collect payments, maintain the property, and protect occupancy. So, I wanted to test the most passive version. Instead of operating the facility myself, what happens if I hire professional management? Using a modeled management fee of around 6% of gross revenue, the base facility would spend roughly $57,000 a year on management, and our $136,000 of modeled owner cash flow falls to approximately $79,000 a year. That's around $6,600 a month, which sounds pretty good until I put the original investment back beside it. Approximately $2.75 million of equity. Now, I wasn't asking. Can this produce passive income? It clearly can. I was asking, how much capital am I tying up to produce that income? And that was the moment the business finally clicked for me. I had spent most of the investigation looking at the units. How many, what rent, how full, but the units were only half of the equation. The other half was the price I paid for the stream of rent coming from them, because two people could own nearly identical facilities, charge similar rents, and achieve similar occupancy, but have completely different investment returns simply because one person bought the property at a better price. That's the part I hadn't understood. I thought the important question was, how much can the rooms make? But the better question was, how much income am I buying for every dollar I put into the property? And that also explained why our risk case was so dangerous. Our base model produces positive $136,000, but weaker rent and 80% occupancy turn it into negative $69,000, a swing of around $205,000 a year. The building doesn't have to collapse. It doesn't need to become completely empty. Several numbers just need to move in the wrong direction, which made me wonder. If this business requires millions of dollars and careful management of rent, occupancy, debt, and customers, does it actually become better when you get bigger? At first, the obvious scale calculation seemed simple. One facility makes $136,000, so 3 facilities make 3 times that. But that isn't really how scale works. More properties change the operating model. Management gets centralized. Advertising can spread across a larger portfolio. Pricing systems become more valuable. And the capital requirement becomes enormous. So instead of simply multiplying the first profit number, I use the separate, scalable model from the research. 3 comparable facilities would represent approximately $27.5 million of property value. With modeled financing, the equity involved is around $8.3 million. And with management economics improving to around 4.5% at scale, the portfolio produces approximately $279,000 a year in modeled cash flow. This wasn't what I originally imagined when I thought about scaling a storage business. It isn't really a bigger side hustle. It's a real estate portfolio. And that changes what the owner needs to be good at. The physical storage unit is still simple, but now the business involves capital allocation, property acquisition, financing, pricing, customer acquisition, and centralized operations. And when I zoomed out to the entire industry, the scale was much larger than I expected. The U.S. self-storage industry generates more than $61 billion a year. There are more than 64,000 facilities. And after its acquisition of National Storage Affiliates, Public Storage's platform stretches across more than 4,500 properties and around 327 million rentable square feet. That sounds almost strange for a business whose product is basically space, but now it made sense. The advantage at that scale isn't a better metal door, it's everything happening behind it. Better customer acquisition, better pricing data, centralized operations, financing access, property acquisition, insurance, and management systems. So, before deciding what I actually thought of this business, I wanted to look at it from 3 different angles. First, could this work as a hands-off side investment? In our base model, hiring management leaves approximately $79,000 a year, but requires around $2.75 million of modeled equity. So, yes, it can become relatively hands-off. But no, this isn't the normal idea of a weekend side hustle. Second, Could it work as a full-time owner-operated business? Without the separate management layer, our modeled cash flow returns to around $136,000 a year. That can look like a salary, but it still sits on top of millions of dollars of equity. And finally, can it scale? Yes. But at 3 comparable facilities, we're talking about roughly $27.5 million of assets and around $8.3 million of equity to produce the modeled $279,000 of annual portfolio cash flow. So by the time this business really scales, you're no longer just somebody who owns storage units. You're running a capital-intensive real estate company. And that left one last thing to answer. After all the numbers, is self-storage actually a good business to own? I started with one number. 500 units could generate around $952,000 a year. And that number was real enough under our assumptions, but it wasn't the answer, because the same approximate facility could produce completely different outcomes. In the weak case, negative $69,000 a year. In the base case, positive $136,000. In the strong case, positive $317,000. And acquiring the modeled property could require approximately $2.3 million to $3.2 million of equity before closing costs and reserves. That's what changed my view of self-storage. The property level operating margins really can be excellent, but an excellent operating asset isn't automatically an excellent purchase. What matters is what you pay for the income, how you finance it, what rent you can actually collect, how full you can keep the facility, and what it costs to keep replacing customers. Startup capital, approximately $2.3 million to $3.2 million of modeled equity. Revenue potential, approximately $709,000 to $1.19 million across the scenarios we tested. Base owner cash flow, around $136,000 per year. Hands-off version, around $79,000 per year. Strong case, around $317,000 per year. Weak case, negative $69,000 per year. Break even, roughly 77% occupancy under our base assumptions. Customer acquisition, around $60 to $65 of advertising per modeled replacement move-in. Scalability, possible, but extremely capital intensive. Our 3-property model represented roughly $27.5 million of assets and $8.3 million of modeled equity. So, would I look at self-storage the same way now? Not really. At the beginning, I thought the interesting thing was the rooms. 500 doors, 500 tenants, 500 monthly payments. But the doors aren't the part that decides whether the investment works. I thought self-storage was about renting rooms. Now I think it's much closer to buying income, because that's really what this investigation became. You're buying a stream of future rent. And whether that's a great business or a terrible investment depends heavily on the price you pay for that stream. So the sentence I ended up boxing was, a profitable property isn't automatically a profitable purchase. And then I looked back at one number, $9.18 million. That's what our modeled existing facility could cost. But building storage can cost even more per square foot, which immediately created another question. If buying an existing business property costs that much, when does it actually make more sense to build one instead?